For me anyway, it's a case of just waiting. I can't really do anything because a lot of my trading is around the dollar. And I can't justify being a buyer or a seller of the dollar just yet. So there isn't anything to do in my case anyway, really.
Yeah. No, the dollar's been tricky for me too, because we've seen some conflicting economic data, and it's kind of like when it comes to trading the dollar, these moments are not as fun for me because I now have I think you were here when I was discussing this the other day. I did a deep dive on the US economic heat map and why it's just giving me such a neutral reading here. And for new listeners, James and I are both pretty macro heavy traders. We will look at what's happening with inflation. We'll look at jobs reports. We'll look at all these economic readings to help try and decipher, look, which way is the wind flowing? We don't know with certainty what the market's going to do. The dollar could go up, it could go down, but all we're trying to do as traders here on YouTube that do this every single day, all we are trying to do is trying to gauge which way is the wind flowing. And the wind, for my analogy's purpose here, is the fundamental analysis that we do, right? It's ultimately the economies of the world. And in this case, when talking about the dollar, it's the US dollar. And so right now I'm at the same point where I'm just like, we've got some things positive, some things negative, and I'm left with this neutral sense on the dollar. But then I look at the dollar, and if I'm feeling neutral, I'm also feeling like, okay, this might actually be a little oversold too, right? So I'm kind of in this thing where I was bearish for the dollar for a couple weeks here, or a couple months even, on the dollar, more on the bearish side. But now I can't really justify getting way more bearish down at these levels when my economic heat map that I just showed you is getting all sorts of neutral readings on it. We had a good jobs report. So I'm waiting, probably like yourself, James, for the dollar to kind of either base out and start moving higher with some good, perhaps a hot inflation print or a round of good economic reads, or to substantially move lower on some weakening stuff. But right now I'm very in the neutral camp too.
Yeah, well, that's the thing. I think even if the dollar did decide, let's just say tomorrow it goes down to 96, I still, from a technical view, don't really think I could be a seller. Just from a technical view, I'd need to see some sort of pullback, whether it be a small one just to previous resistance or a 50% retracement, whatever it may be. Hold on, let me pull this up, like the H4. So this, to me, even if I sold it down here and it broke all the trend lines, technically the bullish idea is gone. I still couldn't sell it. So there is just no way into the dollar for me right now unless we have good data and it comes up, or we have a natural pullback up, then start going down on bad data, whatever it may be. But yeah, I'm just finding it very, very tough right now.
Yeah, it's interesting because here's the reality for most of the listeners here. We are mostly traders that are shorter term in nature, but when it comes to Forex, I actually am I think I'm in the minority of traders that I'm like way more focused on when it comes to Forex. I'm way more focused on like the weekly and daily chart levels. Like I'm looking at long-term currency moves, as kind of as a bigger picture to what I do. But most traders are really just focused on the here and now, which makes sense, right? The here and now, the recent momentum for the dollar has been bearish. But I do appreciate that, you've been talking about this, and I've seen some of your content recently, just about that longer term, the secular overall longer term demand for dollars, I still think is very high. And this is where you get into, something kind of interesting, where a lot of our studies here that we talk about on the show, in our macro, a lot of them, there's macro from like a midterm length, which I would say a lot of this economic heat map stuff is a little bit more midterm. Like it's not like super, super long-term focused. Now, if you wanted to do, and this might be a future Edge Finder tool, is if I wanted to look at like long-term trends on currencies, what I would probably do would be I would ignore the actual versus forecast components, right? And what I would actually just look at is only the actual. So if I only looked at the actual absolute readings of like the US GDP numbers, US PMIs, they change very gradually over time. It's a very long-term thing. Instead of looking at forecasts and actuals, which is more like medium-term to short-term trading, if you wanted to be a long-term currency trader, which is obviously a lot more of what I tend to do, I typically will look at, CPI on a big picture, 2.4%, rather than like focus on where it was expected to be, but rather where it is on an absolute basis relative to other currencies. Might be an interesting indicator to work on. Like if we were to compare, like if you were to compare the euro against the dollar, right? Just on CPI, for example, CPI in Europe's at 2%. If you were to compare that 2.4% in US, we would expect as a longer term force that higher inflation should keep rates higher in the US, right? So that's like a long term. It could move 1,000 pips in either direction in the meantime, but in the longer term picture, right? Something like CPI, GDP, jobs numbers, unemployment rate, these stats on a long term basis. And I'm talking through this, I'd like to build something like that because I think
it would be good. I'd use that tool.
Yeah, like something just really focused more on the absolute data. Now, again, from a trading perspective, for like 9 times out of 10, I typically do like to look at the short-term expectations of the market versus what's actually happening. But from an absolute basis, might also be good to look at it that way.
I think that would be, I think that'd be good because I'm a big believer in the efficient market idea that short-term data gets priced in quite quickly, if not almost instantly. But you can get these deviations where, yes, in this example, the dollar's core data is actually okay to neutral, but the dollar's value has decreased quite significantly since the start of the year. So having an objective longer term outlook can definitely help filter out, is a currency undervalued, or is it sort of at fair value, if you will?
The market doesn't move in a straight line, and so even a flush down here that shows like the dip, I think that market maybe comes one more time, and that's where I'd rather position for, let's get back to the highs again. That could be a double-digit gain right there.
Yeah, I mean, see, that's the thing, is that's, to me, if we were to get sideways, or in that case, I mean, what sideways truly is, like you get down and you get up. So we just haven't had any down. So if we're going to trade sideways for couple months, I think the way you would get that is you would get, a move like what you're talking about, something lower here. And I think that, you've got the S&P 500 at a 23 multiple. So you're talking about an expensive market, which doesn't mean it has to go down, but it does suggest that, okay, your risk to reward here. And that's my big thing, is this is all risk to reward always. We never, if you listen to Chris and I talk for the audience members, like you're never going to hear us like with certainty thinking, gold's going to do this, Nasdaq's going to do this. It's always risk to reward. And so to me, you look at a market like this and you say, okay, this felt like way too similar to COVID. And we know how COVID kind of part 2 went. The thing just melted up for another year. Are we going to see that environment? Man, I don't know. But I feel like
I think it's hard. I think it's hard to do that round 2. I really think it's hard to do that for a second go of like, I mean, COVID was the whole world put in $6 trillion. This is, well, we're putting in another $3 trillion over 10 years, but it's like, is the whole world going to benefit from this type of move? It's like, we have a trade war, we've got a Fed, we've got higher interest rates, like everything is different. So
yeah, I think that was the contingency.
It's great recovery. It's just not the same. It's not the same at all. And these valuations, I think, are quite high. The Mag 7 still remains higher. I think that the shoe to drop, if we're gonna have a correction, I really think it's gonna be somehow the market has to be disappointed in earnings. I think that's the only thing that's really gonna make any sense, unless this whole like now until August 1st, if Trump like comes out swinging with something totally off base, like one is the 30th of July, and Powell's like, you know what, we're not going to cut for 2020. And this is extreme stuff, but if Powell's like, we're not going to cut, and Jerome Powell and Trump like have a little, it's just Trump. It's like Powell doesn't say anything, but it's just Trump. But if somehow he just like, if Trump just gets more angry, more wild card, it's like maybe he affects the market. But I think the market likes to mute him now. The market likes to ignore a bit of the noise that Trump has created. The market now is probably more focused in on, okay, breadth is still pretty bad right now. and we're hitting some extended conditions that we don't typically see. And earnings season at a 22, 23 times multiple, at a NASDAQ 27 times multiple, we have to have like freaking stellar earnings, because if we don't, then these valuations are going to be adjusted. And that adjustment can be really aggressive, and that adjustment can be really subtle, and you never really know. But I still think that a buy the dip is probably in play for 2025. I'm really not a bear, Nick, until we have like true like bubble type technicals. Like to me, we'd have to run up to like 7,000 or so with no real pullbacks, and I'm just going to be annoyed that I didn't participate for the next 800 points. But if we run up there, like I'm a bear at 7,000, I think I'll turn into a bit of a hedger. You know.
Let me. You made some good points there, and while you did that, I prepped a chart for us.
Okay.
So this is the stock box, still very much in dev mode. But one of the things that you pointed out just a second ago, that is, at the end of the day, you point to a market which is actually experiencing the big players at the table who are taking the lion's shares of earnings per share growth. Talk about Meta, Amazon, Apple, or maybe not Apple, but yes, I mean, all these companies, the big ones, if they start missing earnings, then I think you actually can point at and say that is a sustainable reason why stocks can trend lower. At the end of the day, right, if you're going to look at the indices, NASDAQ, Russell, S&P, Dow Jones, whatever, we have all this noise. Trump says this, market goes crazy. At the end of the day, the number one thing I would say that the stock market, the indices at the index level, what they follow is earnings per share growth. And the thing is, as you pointed out, through all of this chaos, all of this craziness, all the earnings per share, I have an earnings report tracker. 4 out of the last 4, Microsoft have beat their estimates handily. And we can go down the list. I mean, we don't even, you pick your favorite of the big 7 for the most part, other than Tesla and Apple. You've had these dominant earnings reports that have just been a theme. It's like every time this market throws something at it, tariff worries are going to kill earnings per share, Google comes out and swings huge for the fences, right? So you have all these earnings per share actual numbers that have beat estimates. That's why I actually think where we've seen we saw a huge surprise, and this is really what I want to set up for Q2 earnings, which are starting pretty soon for the indices. Mm-hmm. Q1 expectations were in the dumpster for earnings. Yeah. People were like, companies are going to put up terrible earnings, and it's going to be kicking us off into a bear market. What we actually got was pretty solid numbers, and the stock market ate it up, right? It just ripped. But now you don't have that same luxury of low expectations going into earnings. You're right back into high expectations for key players like Google, Microsoft, Meta, all these big players. And I think those are obviously the ones that just matter the most. They're the biggest in the S&P. Those earnings, if they do not absolutely, knock it out of the park again, then we could be in trouble. So I just think that at the end of the day, you really want to point to a sustained down period that does not just get bought up right away. It's got to materialize in the earnings per share estimates getting missed. Yeah.
And that takes a while, because the S&P earnings estimates are still predicting higher earnings, all-time highs. And I think it's the severity of those changes, of those alterations, that would be how the market quickly prices in something bad.
Yes.
Like summertime can be tricky. I mean, last summer it was the Bank of Japan, the deleveraging was given the reason for why the market dropped. I think it was due anyway. It's like we had a little hiccup in April last year. We had a little hiccup in July, and that little hiccup rolled into like the deleveraging, Somro activated deleveraging over the weekend. It showed like true vulnerability over the markets for the weekends. But it got picked right up in that August 5th bottom, and it ripped up, and it had a little hiccup during Labor Day, and it went to all-time highs like past September, October. And then we had a huge bump on the election. It's just like, it's the same stuff, man. It's just up, down, up, down. A sustained downward move is going to have to be like, I feel like all hell has to break loose for a downward move that's going to be sustained. And I would say that if Trump was still 2 feet on the gas of a trade war, then yeah, man, let's go to fresh lows, and let's like just cleanse this market like crazy. But that pivot that disrupted the bond market, April 7th to April 9th, like that window right there, Now Trump is pro-growth everything. Now this big, beautiful bill is pro-growth everything.
I mean, it's
I know.
just a giant stimulus package, right?
Fiscal policy has been the reason the markets have, like, this is why Biden was given so much crap as a puppet president, because they just spent a ton of money. Fiscal policy is what kept the markets heated and running.
Yeah,
And
it's
it was
more
good.
stimulus.
It was good for investors, but terrible for Main Street. But Trump is no different right now. Like, we are literally, we're stimulating again. It's extending tax credits. And whether you have pros and cons to it, it's like there's some ugly stuff in 1,000 pages, as there always will be. But for the most part, it's still the government is willing to spend and run a deficit, and we're hoping we can grow our way through it. And that's a huge if. And right now, the markets can still like lean on the optics of growing and having the narrative and the policy be like shifted towards growing. But it's if we disappoint, though, it could be like the growth shock, right? As we want to grow, but we truly have all these restrictions and headwinds that shows that we can't actually grow. And that hasn't set in yet. That reality has not been set in. So that's what I think would be like the big turning point, is if we're like, man, we want to grow, but we freaking can't, because yields are too high, costs are too high, labor's maybe struggling, whatever, people are pissed. I don't know. But we're not there yet where the optics are being priced in.
Let's start with the inevitable question yet again over tariffs, because we've had one eye on today's date for quite some time now, July the 9th, when the deadline was meant to have ended. But of course, with these uncertain times, it's now been extended, the tariff deadline, by President Trump and his administration. And I suppose, Nick, the uncertainty continues.
In some ways, Johnny, you could say the uncertainty continues, but in other ways, you could kind of take a little bit of solace in the idea that this continuing to sort of back down from tariffs from the Trump administration, at least as perceived by the market, could be taken as a positive thing. The reason I say it that way is because if you take a look at the NASDAQ and the S&P 500, they're pretty close to their all-time trading highs. If there were substantial amounts of uncertainty around the tariffs at this point, we'd probably see the S&P 500 and the NASDAQ down. But it seems like the market now is taking a look at the stance and the things, the commentary from Trump and his administration, and sort of leaning into this idea that, okay, they are way more flexible than they let on initially. In fact, I was actually listening to at the White House yesterday, there was a press conference with Trump, and when pressed about dates specifically, I'm going to paraphrase here, but it was basically what happened to the dates that you just mentioned, right? The July 9th, these hard deadlines. And then Trump kind of gave an answer that, it was always August 1st, right? And pushing it back to it was always August 1st. And that was welcomed by the market, right? Because that gives the market the perception that, okay, these comments from Trump, they have a lot of bark, but there's not a ton of bite here, right? Of course, I do think that if we don't get deals at some point soon, there probably will be a stronger response from the Trump administration. However, what this sort of signaled to the market is that deals are pending, negotiations are ongoing, and if if there was sort of a stance of throw in the towel, nothing's working, tariffs are back on, that would signal to the market, oh, these things are not happening. But it seems like progress is happening with places like Japan and the EU. Of course, these things are still under development and they take time. And so that is kind of the stance, it seems like, of the administration, which is giving, like I said, a little bit of a calming nature to the markets. The VIX is down 4% today, right? So it's down to 16.11. You don't have the level of uncertainty in this market now that you did a couple months ago, where we were sitting at a 60 VIX, where the market was pricing in these massive, massive volatility swings. 16, by the way, that's almost back down to, that's definitely pre-tariff news, and going back to the beginning of the year when things were mostly calm, we're pretty much back to that level of market volatility. Now, critics of this would say that is vastly understating the risks of these tariff deals falling through, but the market is sort of looking at, in terms of stability, they're saying, hey, you know what? Inflation seems to be cooling. The Fed's expected to cut in September, and at the same time, you have company earnings doing quite well in the United States. So in some ways, there is a bit of, we're in a much better circumstance than we were. And in regards to the tariff circumstance, it's sort of okay, deals seem to be going okay, at least to the point that we're not upsetting Trump, so he's not sending out social media posts every day threatening other countries. And as long as that doesn't come back again, the market is kind of okay to stay relaxed. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.